If you're looking at a DSCR loan in 2026, here are the 3 easy numbers you need to understand. Now, DSCR loans may sound complicated, but they're really not. They're one of the simplest loans you're going to find in real estate investing. And when I say simple, you don't have to understand ratios, major calculations. You don't need spreadsheets. You don't need anything like that for the property, your income, or any kind of numbers that we're going to go over. It's going to be simple numbers. And number one is, do the rents cover your expenses? In DSCR underwriting, all we care about is 5 expenses. We're not going to go into everything that a conventional loan or a bank goes through. It's just 5 expenses. So what are those 5 expenses? Number one is your mortgage payment. What is your principal and interest on the mortgage that you're looking at taking out? If you're doing a cash out or rate and term refinance, what is that new loan amount and what is the payments just for principal and interest? That's what we're worried about for number one, is a principal and interest on that new loan. Number two, current property taxes. If you're in most counties and states like the rest of us, taxes seem to be creeping up. So you need to know what the current taxes are for that property. Underwriting is going to go through everything that is the here and now. So we're going to need everything to be up to date when we're looking at it, because remember, we're checking that rents versus these expenses. Number three, property insurance. What is the property insurance and what is the monthly payment on the property insurance for that property? Now, number four is HOA. Not every property has the HOA associated with it, but if you do, whatever the monthly payments are, you're going to have to put those in this equation. And the last one, number five, is flood insurance. If you're in a flood zone, you're going to have to obtain flood insurance and you're going to have to know those numbers. So what we're doing here is we're comparing the market rents against those 5 numbers, which is your monthly P&I, your principal and interest on your monthly mortgage payment, your current taxes, your current insurance, HOA if you have it, and flood insurance if you need it. So it's important to understand you don't need to figure out utilities even if you pay them. It does not matter in underwriting for a DSCR loan. You don't have to figure out vacancy rates. A lot of loans require you to put in a 20 or 25% vacancy rate, maybe 10%, whatever it is. It also doesn't cover things like property management fees or maintenance or reserves for maintenance. All of those things may come into play when you're looking at the numbers for, your cash on cash or your return on investment, or if you're talking to a banker or conventional loan. DSCR does not look into anything besides those 5 expenses. It's as simple as, let's say your rents are $1,500 on this particular property, and those 5 expenses are $1,450. In other words, rents are greater than those expenses, so that property qualifies as far as the income goes. And we made this easy for you. If you look below, we have a very simple calculator. You put these items into the calculator in 10, 15 seconds. You find out if the property is going to qualify income-wise or not. Check the link below. So remember, it's no big calculations. It's no ratios. It's not remembering formulas. It's just, are the rents greater than the expenses? So next up, number 2 is your credit score. What zone is your credit score in? Now, credit score is not going to determine all the time if you get a DSCR loan or not, but it will determine the kind of options and rates and what that DSCR loan is going to look like. Just remember, we're talking rental properties here, so we want to keep the cash flow as high as possible. The lower the rate, the better your cash flow. The higher your credit score, the lower your rate. So we want to focus on making sure our credit score is maximized out, because in real estate investing, credit scores matter. It matters if you're doing flips, rentals, BRRRRs. And the simple guide is, if you have a 660 score, you're in the game. You could get a DSCR loan. But if you have a 700 to maybe 750 plus, you're going to have more options, more lenders looking at your deal, competing for your deal, better rates, better terms. The higher the credit, the better the DSCR loan you're going to get. And I see this a lot. People with really good credit, it just seems to fly through underwriting a lot faster, and the underwriters ask a lot less questions. It's just the way it is. Another point to go over is, it does not have to be your credit score. You have to have good credit, but let's say you have a business partner or a spouse who's on the property. You could use the higher of the two individuals, people who are on the ownership of that property. So remember, it does not have to be your credit score. If one of your business partners, your spouse who's on that property has a better credit score, you could take advantage of that and use their credit score. So maybe you have a 680 score and someone else has a 780 score, you want to use the 780 score because, it's probably at least a point difference in rate. And you know what that means for cash flow? Let me give you an example. I had a client we just closed a DSCR loan for. They had really good credit. Their interest rate was in the low sixes. I mean, about 6.25, I believe was the rate we locked them in at. Another client came to us and was looking for the same product, the same kind of loan to value and a cash out refinance. Their rate was almost a point higher. What does that mean? Well, on a $300,000 loan example, someone has a 6.25 compared to someone who has a 7% rate. That's about $170, $175 a month difference in cash flow that's going to the banks instead of your account. Credit scores matter, and it does not have to be your credit score. So when you're looking at who to bring in for partnerships and stuff, at least have one of you protect your credit, keep your credit up. So when you're looking at DSCR loans, BRRRR loans, whatever it may be, you are going to get the best rates out there. And one last point on credit, I've seen it over and over again. Brand new people never have done a rental property before. All they had is really good credit, and they found a property that had good income. With those two, they're able to get into a loan without any problems. That's the beautiful thing about DSCR loans. Because of the income focused on the property and not you, you could start today and not wait those 2 years that traditional banks want. So number one was the rents have to cover the expenses. Number two, watch your credit scores. Number three, know your loan to values. So remember what loan to value is. It's just what the percentage that the banks will lend you based on the appraised value. An example, you have a property appraised for $200,000 and the bank says we'll give you 75% LTV or loan to value. What that means is they're going to give you 75% max on that appraised value. In this case, we had $200,000 for the property. They're going to give us 75%. That means their maximum loan is $150,000. And when we're thinking about DSCRs, a good safe place to be when you're thinking about LTVs, purchases 80% or less, refinances, doesn't matter if it's a cash out or rate and term, 75% loan to value or less. Of course, there's exceptions out there. You could get an 85% purchase on a DSCR, but you're going to pay for it. Your rate's going to be higher. You got to make sure you really have good credit. There are exceptions to some of these rules, and getting to 80% out on a cash out or rate and term are available too. But typically your standards are, and good thing to keep with the standards, 80% on a purchase, 75% or less on a refinance. That's it. Nothing complicated. Remember, rent's greater than expenses. Keep your credit score up. Know your loan to values. And when you go out and start looking for properties, don't guess. Check the market numbers. Know exactly what rents are. Check your taxes, check your insurance, see if it has an HOA, see if they have flood. Put it in the calculator we talked about. Run your numbers so before you put anything under contract or you reach out to a lender, know if your property qualifies for the loan amount you're looking for. And don't assume every property in the neighborhood is going to qualify the same. Each property is a little bit different in the taxes, a little bit different in insurance, in the repairs and what it'll be appraised for. Maybe there's different bedrooms, baths. Make sure you check the property before you commit any money from a contract or even putting money down for a loan. And it's really those three simple numbers. And DSCR loans are perfect for investors. It doesn't matter if you're a new investor, an old investor, an investor with a lot of properties, or this is your first property. It does not matter if you're employed, if you're retired, if you haven't done your tax returns for a couple of years, because we don't look at any personal or business income. It's all the property and what the property does. So remember to use that DSCR calculator, run your numbers, put it in, take the 10 or 15 seconds before you get under contract, before you put money down on a property, even before you talk to a lender. Know before you start shopping. If you like this video, please like and subscribe, and we'll catch you on the next one.